Hi everybody, I think let's start. We have like a large number of people already in. Don't want to keep you guys waiting. So hi, just quickly to introduce myself, my name is Priya and I'm from TreeLife and we work extensively in the startup ecosystem. I have the area with me, my colleague, who will be taking the session along with me. So quickly, right? What we're trying to do here is that we want to take you all through what an AIF is, how an AIF structure looks like, what are the types of AIFs, what are the regulatory compliances that an AIF needs to do, and also how to get registered as an AIF, right? And what we are trying to do here is to just create awareness on basics of AIF, right? Now, the structures can get complicated as you want it to be, but what we are trying to cover here are the basics so that if you as a founder are dealing with an investor who is set up as an AIF, you know what is behind that structure, right? And if there's anything that you need to know as a founder, then we hope that today's session will give you that clarity. Also, if you are a first time, you are an investor, want to set up an AIF, you want to try and see if you want to manage pool of money, then this session will give you some insights on how an AIF could possibly solve for that. So diving right in, right? There, if you can just quickly move to the next slide. So this is what we are planning to cover. As I mentioned, we will do a quick overview on what's an AIF, how the AIF industry is looking like today. Then we'll go over the regulations of AIFs, then how you can get registered as an AIF, and then we'll leave the floor open for any questions, right? While we will have a separate Q&A session for any specific questions, feel free to drop in your questions in the chat in the webinar. We will try and answer as many as we can during the course of the next 1 hour, right? Got it. So moving on. Got it. So we just quickly look at what AIF is, right? So what happens is that HNIs and large investors typically have few avenues of investing, right? A mutual fund is one, and a direct investment is another, right? So AIF is kind of like a bridge between the two, right? Where AIF is like a fund, it's a pooled investment vehicle, which it means that 3-4 of us can kind of come together or more can come together and kind of say that, hey, we are collecting a pool of money, all of us, and then we'll appoint somebody to manage that pool of money, right? While a mutual fund does that on a more retail basis, an AIF is more non-retail in that perspective, right? It's more privately pooled investment vehicle, right? They can collect funds from Indian or foreign investors, and then they have an investment manager who kind of manages that money, which means that they kind of take the decision on whether to where this money should be invested and when it should be divested and stuff like that, for which the manager kind of takes some fee and some carried interest, which we'll get in the next couple of slides, right? Now, AIFs has really picked up in the last couple of years, right? Ever since COVID has kind of come in, there has been an exponential surge in, right? It has become a very exciting asset class, right? As the Indian markets perform well, the rich are getting richer, and there is a lot of money or wealth that has been created across India, which people are very interested to kind of invest in alternative asset classes, right? Your normal investment classes continue to exist, which is your gold or your fixed deposits or your mutual funds and all of that. But an AIF becomes a more alternate asset class, which has emerged over the last 4 to 5 years and has grown exponentially, right? Now, when I say that, what I mean is that if you look at the charts, right, if you see from FY21, there has been a great upward surge in the number of AIFs and also the commitments, right? And this kind of is driven by overall market sentiment also, right? Because as the markets kind of grow, there is more capital with people to kind of at their disposal to kind of invest, right? And this additional capital is where people are okay to take the risk of high risk, high return, right? Because AIFs also come with a high risk, high return kind of philosophy, because they do invest in specific assets. For example, there are startup investments which are made by AIFs, and also algo trading, all of that, right? So they all come with, most of AIFs come with a high risk, high reward kind of a thesis. Now, if you look at the data, then there are more than 1,500 AIFs already in India, which means that there are 1,500 privately pooled vehicles where people have kind of put money, and then there is a manager who kind of invests that money across India and sometimes even outside India. Commitments have surged more than 77% in the last 2 years. Now, commitment means that we get to the terminologies, but I mean, commitment is basically the amount invested broadly. So yeah. Sorry, did I continue on the earlier slide? Also, one interesting thing is that if you look at the last 5 years, right, equity AIFs, which means that AIFs which invest into equity, they have really outperformed the BSE, Sensex, Tri-Index, PME Plus, right? Which means that if, say, for example, you would have invested in a stock in BSE, which you would have curated on your own or stuff like, or with a PMS or whatever, then if that data versus an equity AIF, in that comparison, the equity AIFs are kind of outperformed, right? Which means that having a more curated fund manager who kind of uses a more curated way of doing things, that has kind of outperformed, right? And while Adhere will take you through the categories of AIFs, there's 1, 2, and 3. 80% of the AIFs currently fall under 1 and 2, which is more private equity, debt, and VC kind of AIFs, right? And the balance 20% are all AIFs which kind of invest in the listed space, right? And following that, if you see that overall allocation of AIF pooled money, 70% is to unlisted, while the balance 30% is for listed, right? And also one interesting thing to note is that from 22 to 24, 44% of new schemes which were launched, they were launched by first-time fund managers, right? And here at TreeLife, we have also seen a lot of interest by first-time fund managers, right? So they could be offshoots from larger AMCs or larger funds who kind of have moved out and want to start on their own, right, as a first-time fund manager. And that is something which is interesting, because a lot of people are kind of trying this out for the first time, and kind of trying to create their own AUM which they want to manage, right? And SEBI also acknowledges that, because last year, so just to give you a little bit background, earlier there was a criteria that the fund manager of the AIF needed to have some particular years of experience in the fund management industry. Now they have done away with that criteria, and they have introduced an NISM exam which that person needs to take. So that kind of also tells us that SEBI also acknowledges it and is okay for first-time fund managers having no real experience, but having given that exam, can also launch an AIF. So yeah, so that is just a little bit about where we stand in the AIF industry today and how it has grown, right? Now let's spend some time to understand how an AIF structure looks like, right? Now, what I have tried to cover here is a typical AIF structure, right? Now you can see the triangle in the middle, that is the AIF, right? Now that is your pooling vehicle, the fund entity. Okay. Now if you see that typically this fund entity or the AIF is set up as a trust. Okay, like while SEBI allows you to set it up as an LLP or a company or any other body corporate, a trust is the most opted for option, because that is most easy from a operational perspective, right? Now, because it is set up as a trust, you also need to have a third-party trustee who will act as a trustee on the behalf of the trust, right? There are multiple of these third-party trustees who offer this service. and kind of are part of the AIF ecosystem. The AIF can raise money from investors, which could be either Indian or foreign. Now, as I mentioned, there is going to be an investment manager. The investment manager is like the brain of the AIF, right? Where it kind of makes decisions on behalf of the AIF to invest or divest from any investment, right? For which it earns a management fee and some carry, right? Historically, 220 has been the ratio, but we are seeing that gradually change as competition kind of increases. When I say 220, I mean that 2% management fees yearly and like a 20% carry. But as I mentioned, because of the number of AIFs that have kind of come up, the competition that has increased, we are seeing a gradual fall in this number. Also, now if you see on your right, there is a sponsor. So now your sponsor is like the face of the AIF, right? So when you go to investors asking for them to invest in your AIF, the sponsor becomes the face of the AIF who has minimum commitment in the AIF, which means that the sponsor kind of shows their skin in the game, right? It could be an anchor investor or it could be the investment manager itself, which becomes the sponsor, which basically depicts that the investment manager has some skin in the game in the AIF, and that that skin in the game will kind of ensure that they are not they are going to deal with the money in the most efficient manner. So this is how typically an AIF structure looks like. They're also like a custodian, merchant banker, a custodian, a merchant banker. Is my video off? Sorry, just 1 second. Hi, we are facing some trouble with my video. Just give us 1 minute. Sorry for the disturbance. Can somebody just confirm if I'm audible?
Yes, you are clear.
Okay, I guess I'm having some trouble with my video, but okay, I think it's done. Sorry for the, I think our internet has been a little patchy. Anyway, sorry. So continuing, right? So what I was saying is that while we discussed the trustee, custodian, investment manager, sponsor, there also are other players in this ecosystem which you will require as you set up an AIF, or when you are dealing with an AIF. There will be a merchant banker, an RTA, and other parties, which I think Daria will take you through as we move on, right? So this, we just want to give you like an overview of what an AIF structure looks like. So yeah, moving on, Daria, if you can go to the next slide. Yeah. So before we get into the SEBI part of it, right? And just I don't know if I mentioned this before, but like uh, the Securities and Exchange Board of India kind of regulates AIFs. They have come up with regulations for AIFs, which kind of ensure investor protection at all levels. So the regulations have been drafted and they keep getting amended from time to time, keeping in mind investor protection, right? So the SEBI has ensured that the framework within which AIFs are allowed to operate is extremely investor friendly. So some key terms, right, which you may have heard when you hear of AIFs. So quickly, just want to give you some perspective on that. The first is carry, right? So carry is basically something that the manager of the AIF kind of takes from the investor. Carry is basically performance fee, right? So what it says is that if you have invested 100 rupees, I invest that 100 rupees and I make a return of say 5x on that, right? So say if I've got 5x, 500 rupees on that, there will be a basic minimum percentage which I said that I'll give to you, say for example 10%, and over and above that 10%, whatever additional I make for you, right? From that pool, I will take 20% and I'll give you 80%, right? So this is like a incentive for the manager to make more returns on the pool of money that it has collected, so that any incremental that it receives, he also can get a pie, can get a share in that pie of incremental returns, right? Now, this is what I was talking about earlier, that this is typically 20%, but as I mentioned, that now we are also saying 15 to 20, some even 15% carry, and also lower than that, right? Um, Coming to hurdle is the minimum percentage rate that the manager promises to give to the investor, which means that whatever returns are made, first I will give you your hurdle, which means that this minimum percentage of returns I will give to the investor. Over and above that, whatever is left is shared between the investor and the manager in whatever the carry rate is, right? Catch up is basically something that the manager keeps for himself after the preferred rate of return has been given to the investors, right? So basically, it means that whatever return the investment manager has promised and given to the investors as a part of their hurdle rate. Once that has been paid, then the manager also allows itself to catch up to that, which means that the commitment, the money that the manager has invested on that also, they will earn a hurdle rate, right? Distribution waterfall is basically the priority waterfall, which is defined in the documents, which is followed when the fund earns any return. So typically, a distribution waterfall says that first the capital will be paid to everybody. Second, the investors will get their hurdle. Third is that if the manager has asked for a catch up, then the manager catches up to that hurdle. And the last, then basically whatever pool is left is shared in the ratio of 80-20 with the investors and the manager. Right? So that is typically a distribution waterfall. Uh, Commitment period is basically the period during which capital commitments may be drawn from investors for making investments. Right now, typically commitment period is in the range of 2 to 3 years, where basically some actually it could be much lower. It could be 1 to 3 years also, which basically it means that if I have committed as an investor, I have committed say 1 crore to the AIF. It means that in the next uh, commit whatever the period of the commitment period is, in that time the manager will identify opportunities and draw down money from me. And closing is basically the end of the commitment period, where the manager basically says that this. Moving on.
I believe there's some internet issue at Priya's end. So,
Oh,
like, he has also very nicely given a brief intro of the AIF ecosystem on how it is evolving since the time SEBI had introduced it. And she has also very nicely given a brief of how a typical AIF structure works, along with some key terms and what it means, and general industry standards as to the carry, catch up, and hurdle rates. Now, let us deep dive into the specifics of the AIF regulation. So broadly, there are three categories of AIF which has been regulated by SEBI. First category is category 1 AIF, wherein funds which have a strategy to invest in startups or early stage ventures or social ventures, SMEs or infrastructure or other specific sectors, then they consider registering themselves as a category 1 AIF. Broadly, there are various types of subcategories under this category 1, which includes special situation funds, wherein the intention is to invest only in stressed assets by way of acquisition of loans under ARC mechanism. Then there is a category of angel fund, which primarily invests in startups registered with DPIIT, and additionally, there are certain other conditions which SEBI has um, revisited in September 2025 only very recently. So there has been an overhaul of angel fund regime by SEBI recently, which we will discuss later on. Then there is a category 3 AIF, wherein the funds which have the strategy to invest primarily in listed securities, with the balance being flexible for investment in unlisted securities, then they should register themselves as a category 3 AIF. Now, the AIF regulations as such do not per se specify what it means in terms of percentage investment when it says primarily investing in listed securities. So, the general industry parlance here is to invest more than 50% in listed securities and balance in unlisted securities. And the typical examples of category 3 AIFs include hedge funds, long only listed funds, IPO funds, which focus on IPO investments. And there has been also of late increasing trend for category 3 AIF because of the reason of QIB status being available to AIFs for IPO participation, which enables such AIF to ensure proportionate allotment on IPOs being applied for. So this is very interesting uh, use case being explored by the investment managers or family offices at large. However, this being said, for category 3 AIF, there is one more point that needs to be taken in mind by single family offices intending to avail this QIB benefit, wherein the SEBI has introduced a circular saying that there would be a requirement of enhanced due diligence for single family offices using category 3 AIF as a route only for the limited purpose of availing QIB benefit. So that is something that the single family offices need to keep in mind while evaluating category 3 AIF as a structure for IPO investment for getting QIB benefit. Now, the residue of what does not fall under Cat 1 and 3 is considered generally as a Category 2 AIF, wherein again the primary investment should be in unlisted securities and the remainder can be in listed space. Again, for primary, what it means here is more than 50% should be invested in unlisted securities, while the remainder can be invested in listed securities. And a typical example of what falls under category 2F is a private equity fund, debt funds, venture capital fund, or a real estate fund, or a structured credit fund. What is important to note here is any category of AIF is allowed to invest in securities and not the asset directly, meaning they thereby say, for example, there is a real estate fund registered as a category 2 AIF. Then What it can do is invest in the securities of a private limited company or become a partner in LLP, but it cannot straight away acquire land. So this is an important point that needs to be factored in. However, there is one exception to this, wherein in case of a special situation fund, such funds are allowed to acquire loans and not the securities under the reconstruction mechanism. So this was the requirement as to the investment in securities as mandated under the AIF regulations by SEBI. Now let us deep dive further into the other features of all three categories of AIF. Then the first one, what is the minimum corpus requirement for any category of AIF to start with? Then it is INR 20 crores. The follow-on question being, what is the minimum investment per investor required to invest in any category of AIF? It is 1 CR, meaning thereby any resident or non-resident can invest in an AIF wherein they have to invest bare minimum 1 crore. As to the eligibility for the AIF to raise funds from non-resident, it is to be noted that where the investment manager and sponsor are owned and controlled by person resident in India, the AIF can in turn raise funds from non-residents without any restrictions under FEMA, subject to a compliance requirement under NDI rules, that is to file Form INVI. That's the only requirement to comply with so far as raising funds from non-resident investors is concerned. While from resident investors, there is no such restriction where the investor is committing 1 crore minimum investment. Then comes the continuing interest of sponsor manager or the skin in game that the sponsor has to take, as we call. For category 1 and 2 AIF, it is 2.5% of the corpus or 5 crores, whichever is lower. So say for instance, if the corpus is 20 crores, then what the AIF has to contribute bare minimum is 2.5% of 20 crores or 5 crores, whichever is lower. While in case of a category 3 AIF, it is 2.5% or 10 crores, whichever is lower. Now, an interesting distinction as to the tenure for a category 1 and 2 AIF versus category 3 AIF is that category 3 AIFs are allowed to be operated as open or close-ended as may be decided by investment manager. The reason here is that the primary investor investments are into listed space. So this can be done as an open-ended AIF as well. While category 1 and 2 are primarily into unlisted space wherein the tenure of a particular investment is larger, and for that reason that they are required to be close-ended fund with a minimum tenure of 3 years as mandated under the regulations, and there is no such restriction as to the maximum tenure, provided the maximum tenure so decided as to be mentioned in the scheme documents. Moving further, what are the borrowing stroke leveraging norms applicable to various categories of AIF? Then for a category 3 AIF, engaging in leverage is allowed, but up to a limit of 2x of the NAV or the fund value as on a particular date of entering into leverage. While for a category 1 and 2 AIF, borrowing restrictions are a bit stringent, wherein it says that borrowing can be done only for meeting the temporary funding requirement, wherein, say, for example, you have a drawdown schedule 30 days after today, and as of date, you have an opportunity you want to invest in ASAP, then you can engage in borrowing for such occasion. However, such occasions should not exceed 4 times a year. Additionally, that borrowing amount is also restricted to the lower of three limits that is mentioned here, which is lower of 10% of investable funds or 20% of the proposed investment in the investee company or undrawn commitment from investors other than the defaulting investors. So this limit has also to be complied with whenever the category 1 or 2 AIF are engaging in borrowing activity. As we move forward now, what's the maximum number of investors that are allowed for any sort of AIF? Then it is 1,000. Now comes an important aspect for a SEBI registered AIF, which is what's the diversification norm or what is the maximum investment that is allowed per investee entity. Then in case of category 1 and 2 AIF, it is 25% of the investable funds are to be invested in one university, meaning thereby category 1 and 2 AIF have to invest bare minimum in four entities. So if there is a corpus of 100, they need to invest 25 each in four entities. While for category 3, since the investments are in primarily listed space, the requirement is to invest 10% of the NAV in a single university entity, meaning thereby you can invest only 10% per company. So there has to be 10 rupee investment in 10 different companies if the fund is having corpus of 100 rupees. In now, as a follow-on to this, are there comes a question which is, are SEBI registered AIFs allowed to invest overseas? And the answer to it is yes, but it is subject to a SEBI reporting mechanism wherein SEBI has, in consultation with RBI, has prescribed over an industry-wide cap of USD 1500 million, which is available to AIF as an industry whole. Accordingly, say for instance, a AIF desires to invest certain portion of funds in overseas securities, then firstly it has to reach out to SEBI by way of requisite filings to check whether if there is any unutilized limit out of the aggregate 1500 million industry-wide limit. If yes, then the SEBI would approve that investment on a first come first basis. And if the limit is not available, then the AIF has to be in the waiting list wherein the SEBI would approve the proposed investment on a first come first served basis. Again, an important aspect to note here is that such AIFs, any sort of AIF that is category 1, 2, or 3 are allowed to invest only up to 25% of their overall investable funds in overseas securities. And hence, where it is desired to invest overseas, appropriate structure by way of gift IFSC AIFs can be explored further. Now, going further, w- uh, let's evaluate the eligibility for a particular AIF to invest in units of other AIF. So far as category 1 and 2 AIF go, they are allowed to invest in units of other category 1 and 2 AIF. However, category 3 AIF has the flexibility to invest in category 1, 2, and 3, all sort of AIFs. Then, as we move further, there is a requirement of having one key investment team member, as my colleague Priya mentioned earlier. So, here the requirement is that the key investment team member of the investment manager entity should be having requisite certification cleared as prescribed by NISM in this regard. Earlier, there was a combined examination by the name Series 19C, wherein any category AIF key investment team member could be enrolled and appear for examination, and upon passing of that examination, they would have been satisfying this requirement. But now, with the growing number of AIF ecosystem players, NISM has prescribed two separate categories of examination. One is for category 1 2, that is Series 19D, while the other is for category 3, which is series 19E. So any manager who is intending to appoint a key investment team manager for his cat 1 or 2 AIF can also hire a person who has cleared series 19D examination or series 19C. While for category 3 AIF, a person who has cleared series 19E as mentioned herein or series 19C, either of them can be appointed for. From an individual perspective, if at all it is desired to be appointed as the key investment team member in any of the categories of AIF, then one should appear for series 19C. But if at all the decision is clear as to the joining with a category 1 or 2 AIF, then series 19D would be appropriate, while for category 3, series 19E would be appropriate. It, in addition to this, it needs to be ensured that the person so appearing for this examination and clearing this examination is also having a relevant professional qualification in the area of finance, accountancy, or business management, as mentioned here, or a professional qualification degree from a act recognized by Parliament in India, like a CA, CS, CMA, etc. if at all the same person is not satisfying both the professional qualification and NISM criteria, then a separate person satisfying NISM criteria and education qualification criteria can be appointed for in the investment manager entity by the investment manager. So this was the requirement as to key investment team. Now let's move forward to key regulatory compliances. So these are the certain regulatory compliances that a AIF has to factor in for reporting to SEBI and other regulatory bodies. First is a report to investor, which is to be given annually, which contains information of investee entities along with the valuation of NAV for each particular portfolio investment, material risk, and how they are managed. This is particularly applicable for category 1 and 2 AIF, while there is the other report, other compliance in the form of compliance test report, which says that investment manager will have to prepare compliance test report for the sponsor stroke trustee of the AIF, which is to be submitted within 30 days of the end of financial year to SEBI. Then the AIF is required to give details of portfolio investments on a quarterly basis to SEBI, wherein it would say disclose the amount invested, capital drawdown done, amount deployed in the various investee entities, the valuation of NAV as on a particular quarter, and such other details. However, this quarterly frequency would be replaced for monthly for a category 3 AIF, which is undertaking leverage. So that's the only difference. The general frequency is quarterly, but for a category 3 AIF, which is undertaking leverage, this reporting requirement is monthly. Then, as we discussed earlier, for any sum raised from non-resident investors, the AIF has to file Form INV. This is again transactional. Then there are certain other ongoing compliances like Form 64C and D as applicable to Category 1 and 2 AIF for issuance to investors as regards to their proportionate income and the withholding taxes being deducted by AIF. Then there are income tax related TDS filing, secretarial filing, and GST filings as generally applicable. Now, let us move to the tax implications for an AIF. So, tax implications for AIFs are broadly divided into two parts. One is for category 1 and 2 AIF, while the other is for category 3 AIF. For a category 1 and 2 AIF, the taxation is directly at the investor level and not the AIF level, meaning thereby the AIF trust is having a pass-through tax status. So, accordingly, any income which is distributed by investee entity to AIF is not subject to any withholding. Say, for example, investee entity is distributing a dividend of rupees 100 to AIF. So AIF would receive that 100 rupees dividend income in its entirety, and then AIF at the time, in turn, at the time of distribution of that 100 rupee dividend income would deduct TDS. For resident investors, it is 10%, while for non-resident, it is at applicable rates subject to relief under DTAA if any qua each non-resident investor. So for a category 1 and 2 AIF, the tax status is pass-through for AIF and direct taxation at investor level. And for this reason, Form 64C and Form 64D enables the investors to arrive or derive the proportionate share of income that they have received from the AIF for a particular financial year, which they need to offer in their income tax return for particular financial year. However, for a Cat 3 AIF, which is set up in the form of a trust, the trust taxation rules as applicable generally under the Income Tax Act are applicable for an AIF year, meaning thereby the AIF would be subject to tax in the same and like manner as if it was a assessee on its own, and accordingly any income earned by a Category 3 AIF is taxed at the fund level itself at applicable rate. So for a business income, the tax rate is MMR, while for income other than business income, it is at applicable rate plus surcharge and cess. So any distribution from investee entities to category 3 AIF would be subject to normal TDS provisions, and any further distribution from AIF is after payment of appropriate taxes at AIF level only. So there is no withholding. and any amount which is received by investors from category 3 AIF is not subject to tax again, considering the single taxation principles as applicable for a distribution from trust to beneficiaries. So this was broadly regarding the tax implications for a category 1, 2, and 3, all sort of AIF. Now comes the process aspect of AIF setup. How to get registered as an AIF. So, as to the process flow, the first step is to conceptualize your overall AIF structure as we discussed in the uh, initial slide. That is to figure out AIF trust, sponsor manager entity, investment manager entity, appoint trustee, then also run the commercial math of various parameters like minimum sponsor, the drawdown schedule, who are your target investors, and all that. After the conceptualization stage comes the drafting of key documents of AIF setup. Then the first and the foremost step is to draft the PPM, which is kind of the heart of the entire AIF process, which would include all the details of the investment manager entity, sponsor entity, trustee, the merchant banker, RTA, custodian, auditor, etc. Apart from this, it would also include the investment objective and the strategy being deployed by the AIF, along with the details of commercial parameters such as management fees, carry, hurdle, etc. And it would also have an illustrative distribution waterfall alongside it, which would specify the repayment to investors under various scenarios, such as what if a AIF makes loss, what if the AIF makes profit of so and so amount. So, given the commercial parameters, what AIF has adopted or is proposing to adopt, what shall be the payout for the investors in different scenarios is being explained in the waterfall mechanism working that forms part of PPM. Apart from that, there is a tax chapter in the PPM which lists down the tax implications for the investors of in various situations for various categories of income, both for resident as well as for non-resident investors. Apart from this, then there is a requirement to identify the sponsor manager entity, meaning thereby if you have an existing entity in your overall group entities which can be used as sponsor and manager entity, great. Otherwise, a separate entity would have to be incorporated either as a private limited or as an LLP, depending on your commercial requirement and considering the tax implications for a private limited setup versus LLP setup. Apart from this, you also need to draft a trust deed as we discussed that AIF is formed in the form of trust. Once this trust deed is drafted for, it needs to be registered with the registrar of a respective state wherein the office of the trust is proposed to be situated. This registration process is generally guided by the professional trustee company in consultation with the consultants and an advocate to be appointed for this purpose. Once this is done, then comes the requirement of appointment of various third-party agencies such as a merchant banker, trustee company, custodian, RTA. Then it needs to be ensured that the investment manager entity is having one person either as a shareholder stroke partner or as an employee who has cleared the NISM examination that we discussed above. Once all these requirements are kind of fulfilled, then the PPM that is being finalized would have to be certified by merchant banker for a category 2 and 3 AIF application and for some certain categories of category 1 AIF. Once the merchant banker certifies the PPM, then the application is being filed with SEBI in Form A on SEBI SI portal online along with payment of relevant fees. Now comes the question, what are the fees for registering various categories of AIF? So that fees are 1 lakh rupees for a SEBI application fees irrespective of a category of AIF, meaning thereby for you to create your credentials on SI portal for registering your AIF, you need to pay a fee of 1 lakh plus 18% GST. Then upon filing of your application and upon receipt of approval from SEBI, you need to pay fees as mentioned for respective category here under upon receipt of approval from SEBI. So For angel fund, it is 2 lakh for a category 1 AIF. Other than angel fund, it is 5 lakh. For category 2 AIF, it is 10 lakh. While for category 3 AIF, it is 15 lakh. These fees are to be paid upon receipt of approval from SEBI. Now, as we discussed earlier, what are the key documents that are required for setting up of an AIF? Then the first one is private placement memorandum, wherein we discuss the brief contents to be mentioned in the PPM. The second one is the trust deed, which is also known as indenture of trust deed. Very one important aspect to note here is that SEBI allows you to have the language in the trust which enables you to launch multiple schemes under single trust, meaning thereby you can draft the trust deed in a manner that you just have to amend the relevant portion pertaining to scheme names at the time of launch of subsequent scheme without having to register a separate trust altogether, thereby enabling single trust multiple scheme structure. So this was one important point to note. Apart from this, there is a contribution agreement, which is the agreement between contributor, that is the investor, trustee, and investment manager for investing in the AIF. And the second is an investment management agreement between investment manager entity and the AIF and the trustee, wherein the duties and responsibilities of trustee and investment manager as to the affairs of AIF is being delegated appropriately. So this was the document requirement. Now, coming on to the recent updates from SEBI on AIF ecosystem, there has been two very interesting and important updates from SEBI. One is enablement of co-investment framework by SEBI for category 1 and 2 AIF from September 2025 onwards, wherein SEBI has allowed category 1 and 2 AIFs to offer co-investment facility, but it has to be, the AIFs have to ensure that such facility is offered only to accredited investors. Accredited investors mean the person who satisfies certain eligibility criteria like a bare minimum net worth, depending on the category of person. So this can be offered to such accredited investors by launching a separate co-investment scheme, which forms part of overall AIF structure itself. As to the investment limits, the co-investment that are raised by from an investor for a particular investee company investment, it should not exceed 3 times of the contribution that is made by such investor in the total investment made. So say for example, if the investment is proposed to be made of 100 rupees in the investee company, and an investor wants to take an additional skin in the game by way of this co-investment model, then his investment should not exceed 300 rupees for the example that we discussed. Now there comes a requirement of what are the other operational stuff regarding a co-investment scheme model. Then the AIF needs to ensure that each co-investment vehicle has a separate bank and demat account along with a ring fencing vis-a-vis the assets of other scheme, and also it needs to ensure that this co-investment vehicle does not engage in any sort of leverage. So these were the broad contours of the co-investment framework for category 1 and 2 AIF, which has been introduced by SEBI in September 2025. Again, thereafter, very important update which has been brought in by SEBI as to the angel fund framework is that now the angel funds are allowed to raise funds only from accredited investors, reducing their eligibility or the flexibility as was available earlier. Since earlier there was no such requirement to raise fund only from accredited investors. This narrows down the investor pool which was available for angel fund investment managers, and as a result, we are seeing more traction now from angel fund related discussion now exploring category 2 AIF instead. However, there are certain operational challenges as to minimum corpus requirement being higher, but since there is no such requirement of onboarding only accredited investors, it offers a bit more operational flexibility subject to the point that there is enough commercial rationale for having a higher corpus as against a normal angel fund. Now, Since the requirement is introduced in September 2025, SEBI has also clarified that all the new angel funds which are registered after 10th September are required to fulfill this criteria, while for the existing angel funds, they have provided time until 8th of September 2026 to comply with this revised norm. And as to the first close requirement for these new angel funds which are registered with SEBI, SEBI has introduced a condition that angel funds can now declare first close, which is like the initial closing, after receiving commitment from at least five accredited investors within a period of 12 months from the date of SEBI approval. So this was a important change. Earlier, it was not linked to any sort of number of investors, but the minimum corpus. Now it says that angel funds have to declare first close within receipt of commitment from minimum five accredited investors within 12 months. The period remains same. Apart from that, there are certain other changes in the overall angel fund regime as to the follow-on investment in the startup company which does not fulfill the turnover criteria, filing of term sheet, etc. So this was broadly regarding change for angel fund regime by SEBI in September 2025. So this was it for the session. Happy to answer any questions that anyone has.
इसको तो क्या बोलूं? Um, Thanks, Adhere. Pushpan has raised his hand. Pushpan, you have any? Yeah, Pushpan, you have any question? Yes, Ashish had a question.
Hi Priya, hi there.
Hey,
Quick,
hi, Ashish.
quick question. You mentioned the trust
Mhm.
is the preferred structure for
Right.
creating an AIF structure. Um, what would, can we compare what would a company structure look like? I mean, assuming
So
that,
see,
yeah,
I'll tell you, right? So broadly, two reasons. Okay, one is that if the company, if you set up first of all the compliances, right, about creating a company, doing all the MCA filings because it will work as a company. Second is that when you onboard investors, you have to issue shares to them and kind of do a private placement and all of that. Third is that confidentiality, right? Your company documentation can be downloaded from MCA and become
uh,
visible to all, right? And that is the primary reason why company doesn't work, and also tax, right? So any distribution that the AIF makes, then it will be go as dividend or something like that. So that becomes extremely complicated from a tax and operational perspective. And same way for LLP. One is that operationally very difficult because you have to add a partner, and then when someone leaves, you have to remove them as a
mm,
partner. And also,
LLP, I agree that there's a very big
yeah, and
issue in
also confidentiality, right? The LLP deed can be downloaded from MCA.
yeah.
So, from a confidentiality perspective, it doesn't really.
Company, I agree with you. Confidentiality does not matter. When you talk about dividend distributions,
Mhm.
confidentiality, sorry, makes it difficult. But when you talk
Yeah.
about dividend distributions, would they not be exempt, or considering it's just an AIF distributing, income which has already been taxed,
So the
and
interplay.
yeah,
Sorry, go on.
this is in the context of a category 3 AIF. Sorry to not provide that context.
Got it. So see, Ashish, what happens is that the interplay between dividend distribution tax provisions and the income tax provisions 115B, I don't
Yeah.
think that has been really explored, right? Because of the
Uh,
operational challenges that come with a company, it's not really something. I don't think there's any AIF which is set up as a company. I think
mm.
LLP, when I checked last, I think there were a couple of them set up as an LLP, but that is more from privately held AIFs and stuff like that. It's not like a retail. Yeah.
But is LLP not a difficult, route considering the income tax provisions around
No, so LLP
reconstitution of
anyway is
partnerships?
single level tax, right, Ashish? So then that becomes easier. from that perspective versus
No,
a company.
my question was around reconstitution of LLP. Say, for example, new
Yeah,
investors
yeah,
come in.
absolutely, it's difficult. Yeah,
Yeah,
yeah.
yeah,
And
fair
also,
enough.
like, you have to do filings with MCA every
Yeah,
time you change your deed and all of that.
yeah. That's helpful. Thank you so much.
All right, thanks, Ashish. Yes, I think RJ has a question. Hi.
Hi. So I have two questions. My first question is that a category 2 AIF, suppose they have taken investors, is there a time within the 10-year life cycle or whatever, within which they have to call the entire commitment of 1 crore by the investors? Or is it possible that the fund can even end without calling the entire amount from the investors?
So the ideal situation is that you set a timeline of say 1 to 3 years or something like that to say that this is the time in which we will draw down. But say for example, the fund is not able to identify any investments and it doesn't draw down, then what happens is the fund kind of declares a close saying that now we've declared our final close and basically to say that we have not uh, actually, it's a bit tricky, RJ, because the SEBI regulations require you to have commitment of 1 crore. So then that will also result in violation because then it means that you've taken less than 1 crore. But I mean, we'll have to figure out how to structure this. But I mean, I think that would result in violation because 1 crore is minimum.
Okay. The second question related to this same thing is, what if some of the members or LPs refuse to pay a certain tranche? Suppose they've invested 70% of the amount and they don't pay the last thing. So what is the recourse for the fund?
So typically, the private placement memorandum of the fund will have a clause to talk about what happens when an investor kind of does not pay the drawdown. If it's like so, there is also a concept of excused investors. So basically, the fund can specify certain criteria, saying that in these situations, the fund will allow somebody to not put the money and then kind of have a computation mechanism of how his returns will be calculated. But I mean, recourse from a manager perspective is that it can then levy interest or kind of forfeit the earlier units and different mechanisms like that, right? But so long as it's more than 1 crore, right? So because then that also should not happen that he's not able to fulfill that 1 crore. So then I think the recourse is that you forfeit the units.
Okay. I asked this in the context that I've come across, in fact, as an investor, I've been approached by a number of funds which come and say, sir, you will never have to pay the entire 1 crore. We will never be drawing down the entire 1 crore. So is that really something which these people are, giving false information or?
That is kind of surprising because see, SEBI mandates you to. I mean, you're going behind. I mean, you're kind of going around the intent, right? The intent of SEBI is to limit this to people who have the capacity to commit 1 crore. Right now, if you just do it saying that you commit 1 crore, but we'll take only X amount, then I don't think you're going with the intent, right? So I'm not sure how that will play out with SEBI.
Okay.
They would be referring to you being allowed to remit that 1 crore in tranches and
Yeah.
not at one go.
No, what they say is that we will have some tranches, but we will definitely not be drawing down the entire 100% from all investors. So I don't know. Obviously, it's some kind of a malpractice. So my last question is that this new change with respect to the angel funds. So suppose I have invested in a category 1 AIF earlier. Does that mean that that category 1 AIF, assuming it has another 4 years of life left, will also have to seek an minimum commitment of 1 crore from existing members, or how does it play out for existing category 1 AIFs?
No, so category 1 is separate, right? Only if you are an angel fund under the category 1 AIF, then the new
Angel
AIF.
fund. I mean angel fund, yeah.
Angel fund, right? So see this, I think they have given a 1-year transition period. I don't think it means that now you have to put 1 crore. I think means that going forward they can only accept from accredited investors, right? And anyway, now the new angel fund framework does not specify 1 crore. It just says that the investor has to obtain an accreditation status. It can then invest as much amount.
Okay, fine.
Yeah.
Thank you. Thank you very much.
Thank you.